Here's the scene I want you to see. This is in a mortgage company. Imagine a boardroom meeting. And somebody says, we have to send monthly statements to our clients who have mortgages through us. And somebody says, well, there's also this law, since we're considered a debt collector a lot of times, that we have to only tell the truth. We can't lie. And somebody on the board goes, well, what do you mean? We can't send statements without lying. And surely the FDCPA, Fair Debt Collection Practices Act, does not apply to us because we have to send these statements. If we have to send the statements, we can lie, we can be untruthful, we can be unfair, we can be unconscionable. Nothing any consumer can do for us. And that's what they did here. So let's take a look and see what the 11th Circuit, this is against Face Servicing, July 1st, 2022. Let's see what they said. They start off and they say, look, part of the job of a court is if you have a law passed by Congress, another law passed by Congress, and they crash together, sometimes the courts have to try to figure that out. But just because you have this law, and they both regulate the same conduct, here's the novel concept. Comply with them both. Just follow both laws. So let's see what happens here. We've got Truth in Lending Act, and that says you have to mortgage clients, send a periodic statement, monthly statement. And you have the FDCPA that says to a debt collector, and in this situation, this mortgage company is also considered a debt collector, that you can't lie and you can't be unfair. And they say, it's really shocking concept. They go, we don't see any conflict. You can send a periodic statement that's also truthful and fair. Now, again, you can just hear the meltdown among mortgage companies go, what are they talking about? We have to be able to lie in our mortgage statements. You can't expect us to tell the truth. Actually, yes, the 11th Circuit does. So if you're in Alabama, Georgia, Florida, you're a mortgage company sending periodic statements, the novel concept, hard as it is to believe, is stop lying, stop being unfair, stop being unconscionable. Tell the truth. It's not that difficult. So here's what happened. We get sort of a dogfight between the homeowner and a mortgage company, and they agree to settle it where the homeowner pays 85 grand, 86 grand, and they've got 1 year to pay it. So it's pretty simple, right? Oh, 86,000, I got 1 year to pay it. 4 months later, mortgage company sends a statement saying, guess what? We've accelerated your loan. It's all due right now because you're late on your monthly payments. They don't have any monthly payments. They've got 1 year to pay 86 grand. And they say, if you don't, pay this, now it's 92,000, almost, 93,000. It's due in a month. If you don't pay it, you may lose your home to a foreclosure. And then they say, here are the bunch of ways you can pay us. And every month they get a new statement that amount's ticking up. Well, remember, it was a set amount paid in 1 year. Well, now that amount's even higher and it goes up every month. So this upset the consumers because they're only supposed to pay 86 grand and they have got 1 year to pay it. So they sue saying, hey, you violated the FDCPA. The district court, the lower court, or the trial court says, no. I mean, this is not related to debt collection because they have to send the monthly statement. So it cannot possibly be covered or governed by the FDCPA. To the district court, the periodic statements were unrelated to debt collection, even though they said you're past due, and even though they say, hey, you have to make these payments, because Face Servicing was required to send them under TILA, or Truth in Lending Act. Thus, you can't state an FDCPA, Fair Debt Collection Practices Act claim. And so it says, while this appeal was pending, the court explained in Daniels v. Select Portfolio, have to try to give meaning to both. And they said, in that case, the consumer could bring a claim under the FDCPA, even though it was required under TILA. And they say, likewise, we have to consider, have the consumers here plausibly alleged the periodic statements were attempts to collect a debt. If they're not an attempt to collect a debt or to induce payment, then it's not really covered, at least under this section of the FDCPA. And so what's the standard here? You see this in cases, plausible on its face. It just says, as we read the lawsuit, read the paragraphs of the lawsuit, is it plausible that the plaintiff can be successful? Not is it like a 1 in a billion chance, but it also doesn't have to be like you're weighing in the scales of justice and you have to tilt it slightly. No, that's to win the case at trial. This plausible just means a judge says, I can see how this could violate the law. And so now let's look at the law. FDCPA says don't make false or misleading representation. That seems kind of common sense, right? If you're a debt collector, stop lying. I know, it's crazy. The debt collector's like, how can we operate under these restrictions? You have to. Stop lying. And then the allegation is you sent this periodic monthly statement that contained false information. Now, while they don't say it here, I think the implication is it was unfair, unconscionable, because we got a deal, 86 or 87,000 in 1 year, but yet you're threatening to take my house. That's unfair. That's just like beyond the idea of fair play here. That is unconscionable. And so contain false information suggesting that face servicing was ignoring the settlement. You owe this larger amount sooner. So the question is, were those representations that you owe a larger amount and it's due sooner, were those in connection with or means of debt collection if they came in that periodic statement that admittedly is required by the Truth in Lending Act? So communication has a necessary nexus or connection with collection of debt if it conveys information about a debt, which it would, and its aim is at least in part to induce the debtor to pay. So let's stop right there. So you get something from the debt collector. Is it about the debt? It would be kind of weird if it wasn't, right? I mean, they're not sending you a happy birthday card. So it's about the debt. Now we go, is its aim at least in part to try to get you to pay or to get you thinking about paying? Because if it does, then it's going to be a communication about a debt, and that's covered by the FDCPA. So we view it holistically. It just means we look at everything, okay? So there could be a statement in there, this is not an attempt to collect a debt. But we could look at the rest of it and go, actually it is an attempt to collect a debt. So a comprehensive view of the monthly statements revealed they had both traits. They told about the remaining principal, interest rate, amount owed, date it's due, delinquency on the account, and you're advised to pay. You must pay this amount to bring your loan current, or you'll have additional fees, expenses, may lose your home. And then they had a payment coupon, where you it's got the little scissors, you cut it off, detach and return bottom portion with your payment. And then they give you on the back of it a bunch of ways to pay. And so the FDCPA claims can survive as long as their complaint alleges the statements plausibly aimed, at least in part, to induce them to pay. And they go, look, this is easy. Sometimes it's like, man, that's a close question. No, this is super easy. Well, why? Because it said, here's how much you owe, here's when you owe it, and you better pay, bad things are going to happen, and you can pay this way and this way and this way and this way. That's trying to get you to pay. So here's what face service says. They go, no. We have no liability. We are unconstrained on the FDCPA's requirements to be truthful. Those don't even remotely apply to us. Why? Because Truth in Lending says we have to send these statements. So think about it. Here's a mortgage company arguing to the 11th Circuit Court of Appeals. These are the appellate judges over the federal courts in Alabama, Georgia, and Florida. And they say, look, guys, this idea that we have to tell the truth, absolutely false, ironically. Absolutely false, because we're required to send these statements. And if we're required to send statements, we can lie in them. We can be untruthful. It's a pretty bold argument, right? They say, we're unpersuaded. So let's look up here. And so, here's what the periodic statement's supposed to say. The amount due, due date, any details of delinquency. Here's the goal. Assure meaningful disclosure. And they say both Truth in Lending and FDCPA apply. We can't pick and choose. And we harmonize these overlapping statutes. It's not like they're doing this. It's just they both govern these periodic statements. And they go, well, let's just give effect to that. Here the task is simple. Nothing in the Truth in Lending Act says a periodic statement cannot serve as a means of debt collection. And they're not in conflict. Look, here's what TILA requires. Send periodic statements. Here's what the FDCPA requires. Be fair. Be truthful. They reinforce each other. And I think this is the court kind of being a little bit funny here. We see no conflict requirement statements of under the what? Truth in Lending Act be, in fact, truthful, right? So again, imagine a mortgage company arguing to the appellate court. When we send statements required by the Truth in Lending Act, we cannot be truthful. That makes no sense. So the purpose of the periodic statements, according to the mortgage company, is to inform. And they go, well, yeah. And a communication can have more than one purposes. And you might have sent to inform, but it's also governed by the FDCPA. And just think about it, common sense. It's to inform. Does that mean it should inform you by lying to you? No. If it's going to inform you, it should tell the truth. And then they say these dual purposes, notification and collection, can exist even when periodic statement resembles a template provided by the CFPB, Consumer Financial Protection Bureau. And they say, look, it's great to have a guide, but there's nothing in that form document that says you should lie to people. Look at what the 11th Circuit says. Does not give servicers, mortgage servicers, a license to insert incorrect information. I mean, how bizarre would that be if the CFPB said, guys, here's a form thing, you should use this, use it, you'll be safe. And by the way, it lets you lie to consumers. No, it doesn't say that. Of course you have to tell the truth. In any event, periodic statements here contain far more language than the model form did. And, this idea of like detach and returning with your payment, and back of each page dedicated to detailing ways to pay, and then face servicing grasp at one more agency document. It's a bulletin from the CFPB. And let me explain this and we'll look at the text. So you have this idea of a cease and desist communication or a refuse to pay. You can send that to a debt collector in writing, and now they can't communicate with you. But what if they're also a mortgage company and they're required under Truth in Lending to send a monthly statement? Now we have a bit of a conflict. So let's see what happens here. The 11th Circuit says, yeah, there is a little carve out here for monthly statements, but there's nothing of the sort of what you're saying, mortgage company, that we can lie. Its target is different FDCPA, so the cease communication provision, that collides with Truth in Lending to regularly send a debtor information. And the bulletin says, look, we think, now the CFPB is not the court, but they have a lot of persuasive ability. We think you can send the statements without incurring liability. Well, here there's no conflict. Truth in Lending encourages lenders to give information. That information is useful only if it's accurate and fair, as the FDCPA requires. So if you lie, you're in trouble. I mean, this is pretty simple. Congress often requires companies follow overlapping rules, give effect to each one unless they're irredeemably conflict. Here we hold must comply with both. Dismissal of the complaints therefore reversed. So again, I want you to see this because it's a very important thing. The 11th Circuit had to decide this year, that Truth in Lending and FDCPA, these are not in conflict normally. These are both rules that these mortgage companies have to follow. And it also gives you a lot of insight into these mortgage companies, these debt collectors, how they always want to say, well, that doesn't apply to us. We can lie, we can be untruthful, nobody can touch us. And I just wanted you to see that because it gives you some insight into their thinking. So thanks for watching this, and I'll catch you guys in the next video. Okay, bye-bye.